PayPal stock has received 3 downgrades in January. Is this the end for PayPal stock? Let's discuss. I'm Brian, the Finance Ninja. First, we'll give the floor to the analysts. Let's see what they think. Give them a fair shake. Then I'll tell you my thoughts as I dissect each argument. I will also give you my 12-month price prediction for PayPal stock, so make sure you stick around for that. Oh, I also made a PayPal transaction. Did I buy or did I sell? The disaster started on January 4th from Oppenheimer. Get it? Oppenheimer? Disaster? Okay, moving on. First, let's talk about what happened. Oppenheimer downgraded PayPal to market perform from outperform, citing profitability concerns and a change in its product portfolio. Now, they argued that PayPal's Braintree product, which is part of its unbranded segment, is growing faster than its branded segments, and that this will hurt its margins and valuation since unbranded has lower margins than branded. Now, when's the last time an analyst has downgraded a stock because a business was selling too much? So what do I think about this?
Everything that guy just says, bull. Thank you.
Anyway, here's why I think they're wrong. First of all, PayPal's Braintree product is still growing at very impressive rates, around 32% year over year last quarter. That is massive. And it's serving some of the biggest and most innovative e-commerce platforms in the world, such as DoorDash, Adobe, OpenTable, GitHub, and StubHub. These are not just customers, they're partners, and they provide PayPal with a huge network effect and a competitive moat. See, here's the thing. In e-commerce, there's going to be customers that want the PayPal checkout button, and there's customers that will never have it. Both types of customers are very profitable. Actually, the customers that can afford to have proper security on their checkout pages, they tend to be larger, more well-known, stable customers. Braintree's growth does not subtract from branded. This is not a zero-sum game. Both can and are growing in tandem. So I don't see why Braintree growing like crazy is a bad thing. I also expect Braintree margins to expand as it grows. Economies of scale and all that. One more thing. Braintree sends transactions to Venmo, PayPal, and PayPal Credit, depending on the customer. This vertical integration drives significant revenues and profits for PayPal. Now, Braintree has also global reach. With support for over 130 currencies and multiple payment methods, Braintree is perfect for businesses with a global presence. PayPal's acquisition of Braintree has proven to be a very smart move, as it has allowed the company to expand its reach and capabilities. Second, PayPal's growth is not just Braintree, it also includes Venmo, which is the most popular peer-to-peer payment app in the United States, with over 70 million active users and over $244 billion in annual payment volume. Venmo is a huge growth driver for PayPal as it expands its monetization opportunities through features like Venmo Card, Venmo QR Code, Venmo Pay, and crypto, and Venmo Business Profiles. Third, PayPal's branded segment is growing nicely. PayPal has over 400 million active accounts and processed over $1 trillion in payment volume last year. PayPal also launched products and services such as PayPal Credit, PayPal Checkout, and PayPal Commerce Platform, and PayPal Zettle to enhance its product proposition and customer loyalty. So, as you can see, PayPal has a very diversified and robust product portfolio that caters to different market segments and use cases of the digital economy. I think Oppenheimer is missing the big picture here and focusing too much on short-term profitability. PayPal is investing in its future growth and expanding its addressable market which is estimated to be over $110 trillion globally. PayPal has a clear vision to become the world's leading digital wallet, and I believe it has the potential to achieve just that. Now, the second hit came just the next day, January 5th, one after the other. It's like a hook, or it's like a jab and a hook. It's crazy. This time, the downgrade came from BTIG analyst Andrew Hart. Now, Hart noted that the process of returning the company to consistent and profitable revenue growth was an event that would likely be years in the making. He also noted there was too much uncertainty. But I think these analysts are missing the big picture again. PayPal is not just a payment platform, it's a digital wallet that offers a whole ecosystem of financial services to its users. PayPal's users are loyal, engaged, and profitable. They use PayPal for more than just online shopping. They use it for peer-to-peer transfers, bill payments, subscriptions, crypto trading, and more. Venmo is monetizing its user base through features like Venmo Card, Venmo Credit, and Venmo Pay. Now, PayPal is also investing in new growth areas, such as Buy Now, Pay Later, which is a huge trend in the e-commerce space. PayPal recently acquired Payday, a leading BNPL provider in Japan, for $2.7 billion, expanding its presence in the second largest e-commerce market in the world. PayPal also launched PayPal Pay in 4. Try to say that 3 times fast. I have trouble saying anything 3 times fast. Anyway, that's its own BNPL service in the US, UK, Australia, and France. PayPal Pay in 4 allows users to split their purchases into 4 interest-free payments, and it's integrated with PayPal's checkout system, making it easy and convenient for both buyers and sellers. Another growth area for PayPal is the small business segment, which is where the new CEO, Alex Chriss, comes in. Now, Chris is a former Intuit executive who has a lot of experience in servicing the needs of small businesses and self-employed individuals. He was instrumental in developing products like QuickBooks, TurboTax, and Mint, which are widely used by millions of small businesses and freelancers. Chris understands the pain points and opportunities of this segment, and he will bring his expertise and vision to PayPal, as it aims to become the go-to platform for small businesses to manage their finances, accept payments, access capital, and grow the customer base. Shamo says to like and subscribe. She's also wandering around this room, so you may see her pop up. Now, Morgan Stanley downgraded PayPal's rating, citing delays in product evolution and progress in its strategic imperatives, including enhancing branded checkout and expanding Venmo. Now, this is the third hit in January, and January's not even done yet. This is craziness. Anyway, they go on to state that they expect PayPal to have low teens EPS growth. However, if PayPal can retain low teens EPS growth, they are significantly undervalued. They continue, however, we believe PayPal can grow revenues generally in line with the rate of overall e-commerce, excluding Amazon, and improvements in operating efficiency, along with ongoing share repurchases, can support low teens EPS growth despite pressure on gross profit margin. That sounds like good news to me, honestly. Anyway, low teens is all we need for a 50% improvement in share price. So go right ahead. Now, this next part is where I have an issue. It states, based on our updated analysis and proprietary data tracking, we find that progress on key strategic imperatives has been slow, and the complexity of what needs to be done suggests progress will remain slow with limited P&L benefits in our recommendation horizon of 12 months. Yes, they said 12 months. Now, PayPal just got a new CEO. He's only been in charge for a few months. I mean, what? Let's see what his plans are in the earnings call in February before calling him a failure, for crying out loud. This is insanity. It's just craziness. It's just, what are they thinking? I mean, companies the size of PayPal cannot pivot in the span of a couple of months, especially when the CEO and executive team have been replaced. I mean, this is ludicrous. Oh, and who the hell cares about 12 months? I'm sorry, but I'm a buy and hold investor. I do not care what the stock price is tomorrow. I do not care what the stock price is in a week. I look up 5 to 10 years. That is what I model for. 5 to 10 years. I buy, I hold. I very rarely sell. Now here is a bonus. Andrew Jeffrey from Truist reiterated his buy rating last Friday, just a couple days ago, and increased his price target to $73. He stated, in the long-term bulls, based on attractive risk-reward, but acknowledged that PayPal could remain relatively range-bound until branded volume and transaction dollars stabilize. The five-star analyst explained. That said, we still believe PayPal still occupies an important position in the e-commerce ecosystem. This creates what we consider an asymmetric risk and reward, in which modest monetization and/or share gains could cause a disproportionate positive re-rating. In other words, it's going to take just a little shake, and then boom, the share price will skyrocket. For 2024 and 2025, Jefferies anticipates modest yet noticeable growth in branded volume and transaction dollars. This forecast is tied to the company's initiatives aimed at transitioning from Braintree PSP, that stands for Payment Service Provider, volume to branded solutions. That said, Jeffrey does admit that this is a tenuous forecast, in quotes, that relies solely on discussions with the company and anecdotal evidence that a more assertive Braintree pricing model and early efforts to enhance value-added services around its PSP business offering could create a more favorable backdrop. We still need more evidence that this strategy is bearing fruit, and we recognize that Braintree price concessions could have their own adverse transaction percent repercussions. They went on to add. Nevertheless, Jeffrey states several reasons to back the PayPal case, including the view that e-commerce is a structural tailwind, and that even in the face of competitive challenges, PayPal's two-sided network offers at least as much value to merchants as other wallets, like Apple Pay, and PSPs, like Stripe and Adyen. Moreover, the company generates plenty of free cash flow and boasts a robust balance sheet. Lastly, absent material incremental fundamental deterioration, the stock's undemanding valuation suggests an attractive risk-reward. So as I mentioned before, just a little bit of a fire and you'll get a spark. As such, Jeffrey maintained a buy rating on the shares and raised the price target from $65 to $73, implying investors will pocket returns of 20% a year from now. Now, unlike what the first three analysts say, revenues are good and growing. Share buybacks are here and they are big. PayPal repurchased $1.4 billion in shares in Q3, $5.4 billion trailing 12 months, reducing the weighted average shares by 5%. That is enormous. You see that so rarely. So rarely. That is a lot of shares being bought back, and that's a great thing. Market cap, $66 billion, PE of 18. That is cheap. PayPal is priced for bankruptcy. Forward PE is even crazier at 11. This is cheap, super cheap. It's insanity. Now, this is all I ask for. These absolutely terrible numbers. If PayPal can achieve just these terrible numbers, 2024 growth, 8%, down to 5% in 2032. That's all I ask. Is that too much? I don't think so. Here it is in graph form. I mean, it's pitiful, right? However, I believe if PayPal can achieve that small feat, they are 50% undervalued according to my DCF valuation model on Patreon. However, if PayPal can turn into a growth company again, look out. Speaking of Patreon, I bought some PayPal on January 8th for my Patreon portfolio. It is split up into 3 transactions: 115 shares at $61.49, 16 shares at $61.49, and 0.285 shares at $68.48. Yeah, that's what happens when you enter an actual dollar amount. For a total of $8,072.60 worth of shares. Now, this is a small account I opened about a year ago. It is Patreon exclusive. I do have much bigger accounts than this one, but this is so you guys can track my progress as I build this into a multi-million-dollar account. That's the whole purpose of this. Now, if you want to see my base or bull cases, head on over to my Patreon. My Patreon special is only $1, locked in for life. You'll get access to all of my investment reports and spreadsheets and valuation models. I've got Tesla, I've got Nvidia, I've got AMD, I've got Microsoft, and I've got PayPal, and many others. You also get exclusive access to my Patreon portfolio, as you just saw. Every transaction I make will be posted on Patreon as it happens. You notice that today, that was back on January 8th. PayPal knew before I made those transactions that I was going to make them. You had to wait because you're on YouTube. You can follow every move I make in this account. Watch in real time as I grow this into a multi-million-dollar portfolio. You'll never find a better deal. It has only a few seats left. Get in before it is too late. The link is in the description. So, as you can see, PayPal has a lot of growth drivers and competitive advantages that will help it maintain its leadership position in the digital payment space. I think the recent downgrades are short-sighted and overblown, and they create a great buying opportunity for long-term investors. I believe PayPal will deliver a strong 2024 outlook in its next earnings call and surprise the market with its resilience and innovation. I'm holding on to my PayPal shares and I'm adding more on the dips. I think PayPal is a great stock to own for the next decade and beyond. That's why I'm not worried about the downgrades, and I'm actually buying more shares on this dip. I think PayPal is still significantly undervalued and has a lot of room to grow in the long term. PayPal is a stock that I plan to hold for the next 10 years or more. Don't forget to like and subscribe. Thank you for watching, and I'll see you in the next one.